Very good afternoon to all of my dear students. Myself Parthu Seth. As you guys all know, I'm handling all management subjects as well as specialization in finance, HR subjects for BCom, BBM, MBA, and all students. I hope you guys are all doing well, keeping your health fit. Today I'm going to discuss one of the topics called portfolio management, which is very, very important and related subjects for MBA as well as BBM students, those who have second finance specializations. So, what is portfolio management? Basically, portfolio is nothing but it is a group of assets, or it's a box of different kinds of mix of investment opportunities. So that is a simple term. And if we're going to talk about from finance point of view, basically it's nothing but you're maintaining different kinds of investment opportunities in order to diversify your risk. It is nothing but reducing your risk by diversifying into different investment alternatives. Let's you take example, if you are having opportunities like to take investment into the shares or bonds or government securities or fixed deposits, you can diversify it. Now, I'll come into details later. I'll just give you what is the process of portfolio. How do you build up the portfolio? Basically, when you're going to develop a portfolio, you have to follow certain steps. Let's say the first step is the one where you're going to set your objectives, defining the objectives or specifying the objectives. What is your objectives? Whether you want to have higher return, whether you want to have lower return, whether you want to take high risk, whether you want to take tax saving instruments, tax shelters you are looking, or you want to go for a longer region, longer horizon maturity value, or short term maturity, or you are looking for a liquidity. Based on these kinds of objectives, you are going to process further in the development of portfolio. Now, second thing is that you have to have choice of asset. Choice of asset is nothing but the mixing or the kind of weightages of your investment or weightages of your assets in your portfolio. Usually if you see, the asset mix basically can be divided in two sides. One side is, let's say, the riskier part. Another side is non-riskier part. The securities or investment which are having more risk, and securities which is having very lesser risk. So, I'm talking about, let's say, the securities which is having very less risk or risk-free return types of investment. Let's say you are having bank deposits or government's bonds. So, this is one side. The other side is the riskier assets, like you have the stocks, or let's say you are going for a commodity like gold or foreign exchange trading. So these are all riskier part. So you have to have kind of mix, whether you want to have higher return. So that means if you are going for a higher return, then your weightage of riskier asset will be more, let's say 70%, or the risky-free asset will be 30%, or if you want to have a balanced weightage like 50-50%, or if you want to have more secure, lesser return, then you have to have a 70 to 75% bonds or government securities or other post office savings deposits one side and 30% towards the equities and other riskier assets. So basically that is nothing but you have to decide how much you are going to put your assets based on the risk weightage. The next comes the formulation of portfolio strategy. What strategy you are going to take? When you are doing the investment, you have to think a lot of factors. I mean, the internal factor as well as external factors. Internal in the sense your risk-taking capacity, your income, your age, your the capital. The external factors like the interest rate, the economic conditions, the industry conditions, government rules and regulations. So these are all comes under factors while you're taking portfolio. Basically, if you say the portfolio, like you can divide this portfolio into two parts. One is active strategy, the other one is inactive or passive strategy. Active strategy is nothing but you have to do certain kinds of, let's say, the sector rotation. I mean, let's say today if I am going to purchase into the stocks of pharmaceutical industries, because there is a demand, there is a higher investment opportunities, higher growth side of pharmaceutical industries. Because if you see that today's industrial scenario environment, the people are more prone or more, affected by the viral disease. Different kinds of virus disease. You are having swine flu, Ebola, then you have COVID. So all these viruses coming up, which is threatening our life. So the people need to have more antidotes, or you can say antivirus medicine. So in this company, there is a lot of opportunity you can invest. So you have to rotate. On other side, technology-based company, let's say Google, Apple, the Facebook. These are all social media-based companies which are always, having the very demand, because our lifestyle has been changed or influenced by these companies. Throughout the whole world, people are using these kinds of brands in day-to-day life. So you have to rotate different kinds of stocks. Then you can go for the timings. Then you have to find out what time or whether it is the right time to invest the opportunity or not. I mean, let's say now this is the time where the worldwide there is a recession. So you have to think that if this is the right moment to purchase the shares, to do investment in certain other alternatives or not. So one of the biggest, let's say, entrepreneur or investor, you have Warren Buffett. He always say, buy when the market is at the recession side or lower side. And there will be always an opportunity to go up. So that is how you have to build your portfolio strategy. And on the other side, passive strategy. Passive means you can buy the shares and you can hold it for a long time. When you find that yes, this is the right time, then you can sell it. Or once if you see these stocks are not performing well, if it is not giving a return, then you can sell it. So this is not very active. It is not change continuously. So investment here keeps for a long time. So that is what portfolio strategy. Now selection of securities. As I said, there are a lot of investment opportunities. There are a lot of investment alternatives. You have equity shares, you have bonds, you have government debentures, you have government RBI bonds, you have post office savings deposits, you have bank fixed deposits, you have golds, you have insurance policies, you have mutual funds, you have foreign currency. So there are a lot of investment alternatives are there, and every alternative is having different kinds of objectives, different kinds of return or the risk level based on their risk level and return and their the characteristics you have to select. If you are to go for the higher return, then you can go for the shares of very good company. I mean, blue chip shares. I mean, companies like say Apple or Google or TCS or Microsoft. These are very highly demanded, high price shares. Or you can go for the cyclical shares. Cyclical stock, nothing but these company shares are change with the changes of business cycle, industry cycle, ups and downs. For example, if you're going for, let's say, electronics item, let's say AC or refrigerator or certain other products like woolen products. So those are products which are based on the seasonal demand and supply. It varies. Then you can go for the bonds. I mean, let's say you can go for the RBI bonds or government bonds or post office savings deposit. Based on your risk-taking capacity, if you're looking for a very secure return with lesser risk, you can go for these kinds of securities. You can also go for the tax-saving instruments like insurance, then equity-linked insurance, mutual funds. Then you can take certain kinds of home loans or education loans where you can save tax. If you are going for a more sophisticated investment like foreign exchange trading or derivatives tradings, there also you can do a lot of investment, and there is a lot of opportunity to grow your investment. So depending upon your risk-taking capacity, your liquidity positions, your income level, your knowledge, all these parameters, based on that you can select your securities. Then coming to the execution, as I said, now once you have selected these kinds of investment, you have made a portfolio, then you have to execute. Execute means you have to do certain kinds of transaction. I have to purchase shares, you have to purchase insurance policies, or you have to sell the shares. So you have to go to the dealers, stockbrokers. Or today, now you can do all this trading of shares through online mode. You have a mobile banking, you have a internet facility, you can do through your mobile, you can do through your computers. I mean, today's world is all trading business happening online. Stock markets are all online connected. So Bombay Stock Exchange, National Stock Exchange, or New York Stock Exchange, or let's say Canadian Stock Exchange, Japan Stock Exchange, London Stock Exchange, are interconnected. So today's world, the investment world is totally interconnected through online mode. So anytime you can go and you can purchase and you can sell. Even you can do trading in commodities like agricultural commodities or oil or gold. You can also do purchase and sale. Foreign exchange currency, you can do purchase and sale based on the demand and supply, the price volatility, the information available in the markets. You can do a lot of trading activities and you can make a profit. The specialized brokers are there, those who are doing different kinds of research. Based on the research, based on the information provided by the researchers. You can do trading, value-based trading you can do. So these are actually execution, or nothing but you are going to actually do the transaction. Then portfolio revision. Revision means now you whatever the transaction you are doing, whatever the investment is running, you have to see whether this investment are really doing well. You can change this investment. If you are invested, let's say, invested into the technology shares or software company shares, if they are not performing well, you can go to the chemical industry shares. You can go for the banking shares. If the banking industry is not doing well, you can go for the let's say pharmaceutical stock. You can go for the metal stock. Or if it is not doing well, you can go for the commodity. So you have to let's say revise. You have to see whether these shares you can hold for a long time or whether you can sell it. So that is how you have to revise. And evaluation, nothing but what is the performance. Ultimately, the objective of my investment is to get what? Return, to save my tax, to have the liquidity, to secure my future. If I am going to take insurance, whether I will get back my money. If I am going to put my shares, put my money into the stock market, whether I am going to get high return. So, the evaluation is nothing but basically to find out the performance based on the risk and the return. Return basically you have to find out based on the past data. You have to see how much dividend you have got, how much interest you have got, or how much prices of share gone up, is appreciated or depreciated, whether there is a gain or loss is there. You have to find out. There are a lot of formulas there that we can discuss later. So basically you have to find out the return and the risk. To find out the risk, you have different kinds of statistical tools are available, standard deviation, variance, you have beta to find out the risk. So by doing this certain statistical calculation, you can find out what is the performance, what is the value of your investment at the end of the day. Based on that, you can go further investment, or you can do certain kind of changes in your investment. It is a kind of cyclical process by which you can maintain your portfolio to diversify the risk. You cannot eliminate the risk totally, but you can reduce the risk by diversifying your portfolio. Any queries? Let me know. My number is 8617374894. That is my WhatsApp number, and my email is pset793@gmail.com. Thank you.